to our next session, which is a special presentation by the area management team. And this session will be focused on the topic, building an institution for MSME financing in India.
To the management team of UGRO, it will right on stage one by one. So Amit Mande. Amit is our Chief Revenue Officer. This is not title, but he's one who provides us the bread and butter, which means he handles all of our asset engine. Is a specialist in running asset engine across very large banks in NDFC platform. We've been there for the last 2 years, and the asset growth engine is under his developments. Second, I would request Mr. Anuj Pandey to join me on the stage. Anuj has been part of my founder team. He has been associated along with me with the reform one. He is the design thinker behind the core philosophy of UGRO. So somebody, Anuj, why he generates asset, Anuj enables that asset generation, but make sure that our risk is contained and we deliver to our shareholder what required risk-adjusted return. I request third Mr. Kishore Lodha to join. Kishore has been part of UGRO now almost 2 years. Kishore is our CFO. He has been part of large financial institutions, especially NBFC. And now, so you can generate asset, you can contain the risk, but finally it is the money which drives our business. So Kishore not only in our entire finance function, but also treasury, also investor relation. I will then invite Sharad. Sharad is our Chief Operating and Technology Officer. So some of this through this presentation would see. Our belief is that in this time, when it comes to MSME and financing, there is a massive data infrastructure which is vulnerable. And Sharad is more than 25 plus years of experience, have run large financial institutions, their technology infrastructure. To reach our entire data and technology infrastructure, we request Mr. Sunil Totke to join. And most of you, when it comes to public market investors, how does RBI use regulation, complexity around that? So you need a very experienced hand who not only understand the regulation limits in but also can keep managing the check, because no financial institution will be this time can survive, grow, prosper unless you build a very deep governance and compliance framework. So I've been here for almost 4 years now and have a very experience of more than 15, 18 years and it's our Google in compliance. And last but not least, finally we are a people's company. Over a period of last 2 years, we have grown. At the end of 2020, it's a 120 people company. At the end of 2022, we are 1,500 people company. Today, we are a 3,500 people company. And next 8 quarters, we will be a 5,500 people company. As we reach our retired people's practice as Chief People's Officer, Jasmine has been part of our starting team. She took a break and now come back and join us. So, ladies and gentlemen, this is the management team of UGRO. This is not the root of the team. We were investing very heavily. It was senior on our organization. While we might be the service of the organization, but the underpinning of business and system comes from top 50 people, over 3,500 plus people who work 24/7 to create an institution in India due to deliver insulated performance. So this is the management team. Between me, Anuj, Amit, Kishore, and Sharad, we make an annual presentation for you. So I will start with actually just 2 slides. It is our belief that we over a period of last 3 decades, NBFC within the financial says lending companies, banks in NBFC have been a part of it. Portfolio allocation for almost every investors. Sometimes because we are nothing but actually surrogate to overall broader economy. Credit would define almost every sector of our economy, and credit is being enabled, which means consumer, manufacturing, large corporate, mid corporate, MSME, all of that to start growing from there. But within that, if you look at last year, became something new has emerged when it comes to the non-bank finance company. Whether you call them fintech, whether you call them whatever format, but something new has got created. Our view is that MSME lending in this decade is going to be a large opportunity. And it is not just about the lending. It is about how India is progressing. As you would have seen, very recently in Bangladesh, we are seeing a revolt happening. Why that revolt is happening? It is nothing but a lack of employment problem. In this election, we saw, a real fan of the government come, and you see the budget. The core narrative after the budget was really but nothing but only the employment. Employment in Roti and Rojgar is the key problem. So the political class in our country, finally, you would see that they will see that we do any formation. We do polarization on religion, we do polarization on caste, we do polarization on any other language, linguistic barrier, or. But at the end of the day, you have to provide employment. For a young country like us, if you don't feed employment, people would keep rewarding. And I think so this is a theme, or this is an understanding which everyone has it. And for our country, the largest employer or the potential of employer is only MSME. And the fact is that has come to the recognition of all form of policy making, government regulators. And if actually all of you, and we are reflective on what India is, if all of you believe that India has to reach $5 trillion economy, believe that MSME will be $2 trillion as part of that. What does it mean? It means that net contribution of MSME to GDP would grow from 30 to 40%. Its employment potential will grow from current 12 crore to 20 plus crore. So this is becoming the largest voting block. That's why this is too important for our country. And that is why I need to say that success of a sector or a business is on twofold. One, the sector's potential. Second, favorable policy making. And third, in these two circumstances, great executor of business. So not every FMCG company is a great executor. Some of them are very good, some of them are mediocre. But if the overall ecosystem is favorable, then some has then become an outlier performer. So what is happening because of this, when MSME is becoming large, we have the largest employment generator in our country. Starting from 2014 to 2023, the positive policy dispensation towards MSME has been a continuous theme, and now it is accelerating at a fast pace. When COVID came in India, if you look at visas all over the world, India was the only country wherein all form of support given for MSME. Because governments see that if they don't do it, there will be an exodus of employment. So starting from 2015 to now 2024, every point of time, something or other had been brought for MSME, because a large portion of that is to enable credit. Because when you give a product to a small business, if you employ 10 people and employ 15, a business will grow, and that's where our country will progress. So I want to give you this big theme picture. MSME is India is here to grow. They will become large contributor to our GDP, which means that we need to enable more credit, and that's why there is a favorable policy dispensation. Sorry. Oh. And this is what has happened in the last 3 decades. If I take you back in time, and I would ask you this question, think of 1995, 98. If you wanted to buy a TV, fridge, or a scooter, I keep saying my dad wanted to buy a scooter called Priya in 1996, which came after 6 years of wait. You have to book a Bajaj scooter and you are in the waiting queue rules to come after 6 years. But over the third scholar, who was a professor in university, but to buy that scooter, he opened a recurring fixed deposit. So he has to save money to buy a scooter. So that was the state of consumer and consumer financing in India. But starting from 2008, the systematic shift around a large lender, its balance sheet capacity, its cost of capital, great management team, but more importantly, the bureau score and predictable default analysis created a new market and a new lender. And we became large, which is Bajaj. Think of this around 25 years back. If I were to ask you to say, will you finance a driver who is buying a second-hand truck? You would say how weird that outlook could be. That somebody created that market and became large. And obviously it is a non-profitable business. If you look at gold loan actually, I would ask you that 15, 20 years back you go to your wife in a beer 3 town and so give me your jewelry, it's 3 dharma, and I want to place that jewelry and want to take a loan. It was completely untouchable. But some people created that market. So in every decade, a new category of credit market have been created by NBFC. Honestly speaking, banks have not been able to do because banks architecture doesn't allow to do that. That there is someone who has created that large size. We genuinely believe that MSME financing, an emergence of few large institutions around that is a real possibility, and I still would like to be one. This is a company which will raise 2,700 crore of equity capital, while it has low parentage just on share management capability. In 3 years of timeline, it has built a 10,000 crore business. It has been a sponsorship of almost 60 plus lending partner. It has invested very deeply in data and technology infrastructure. We think that we are at the right time and right place where we could be one of the large institutions. Will be others who will be bigger than us. There will be others who will be smaller than us. But time has come that what we say in the capital market, in the buy side and sell side fraternity, you should watch this space because you would see new institution emerging out of MSME financing, which is predominantly the systematic theme which we have. Yeah, that's largely is the gap. While some of people ask me this question, अरे MSME financing तो सभी लोग करते हैं, इसमें कैसा unique है? You talk to your bank, you talk to your NBFC, you talk to your fintech, everyone want to do MSME financing. Maybe true, but also is the true that in 2017 the total credit gap of MSME was 53 lakh crore and it has grown to 92 lakh crore. If that be the case, that everyone is doing MSME financing, that at least the gap should have been flat, but that's not the real scenario. Why this gap is increasing is purely because of two things. One, MSME's proportion to GDP is growing, but lenders have not catching up in the same proportion. And that's why gap is widening. It will accelerate even further. Second, what is so unique about small businesses that lenders have not been able to date? I don't think so that among lenders, large banks, there is any issue of intention. Everyone wants to do MSME financing. It is the customer and its type and behavior which has not allowed MSME financing in India to grow. If I tell you that in 2012, there is a customer who wanted a 1 crore rupees of loan, and the EMI would be say 8 lakh rupees. And there is a large bank whose credit officer goes to that customer and say, I want to give you a loan. What a lender has to assess? I have to assess, or every lender has to assess the intent of the customer and his ability to repay. Now, most of MSME would show great intent by behaviorally, by data. But when it came to ability to repay, the customer would say, भैया 8 लाख रुपए में 3 लाख रुपए तो मेरा फॉर्मल इनकम से आता है. आप मेरा इनकम टैक्स स्टेटमेंट देख लो, बैलेंस शीट देख लो, जो भी आपको देखना हो. But the balance 5 lakh I collect cash. So because my turnover is in cash. Now think of this scenario that a junior, in the hierarchy of credit, a junior credit officer as a bank has to say yes, wherein 70% of the repayment ability has to be assessed on cash basis. And that what created the credit gap. Because the lender said, no, that is not possible. How do I convince my bosses when you don't have a reported income, but you have only cash income and on that basis I have to give you a loan? Even with that, I might agree with this, but I can't do this, so give me a property, I'll give you a loan. So MSME financing in India finally got constrained by value of the collateral available with MSME. And that has created the historical gap for MSME financing for last 3 decades. But what changed? Actually, I remember when I was in capital, it was evening when somebody came on to me and I was about to close the capital round with a large private equity investor. And he said, buy here and Bono, and demonetization happened. I was so unhappy. But actually, this business, is seed actually starts from where? The first behavioral change with a small business started happening with monetization. If you read this survey was 25,000 MSME every 6 months a year, reports we publish called MSME sometimes in read, which tells us about the health of MSME economy, not on the credit data, but on their operating data. What it started doing that the small businesses started believing that is they remain in the cash economy, there is a serious risk to the business. And that's why the first sign of formalization started happening. Second is that when GST got implemented. Now GST, if you look at it as an architecture, while there is a cost of 18% on GST, if you want to be outside the GST ecosystem, the cost is 25%. Because somewhere in the net you get captured, and that is when the businesses starting, their turnover started getting formalized in form of a GST. Now that's a great way for members to assess the repayment capability. Third, which is also a big shift, when bank's power. Bank has this very enormous power of the bank data. And when a customer opens a current account, when he deposits daily money in that and withdraws that, a banker in a branch can make a very rough estimate how much money he can pay at the end of the month. So that was the power available only with the bank. Now that is getting democratized. It is getting democratized because first, the technology driven, where you can convert a physical statement into a digital and assess actual transactions over your customer bank account. And now it is exploding because we have a system called accountability, which means for every small business customer on a click of a button, even if he has a 6 bank account, I can pull his banking data, which means I have his turnover data digitally available, I have his banking data digitally available, and last but not least, what is right for consumer financing business, which is the builder behavior, which is we call the repayment behavior, which means a small business, how many times he bounces check, whether he pays in EMI on time or not, get recorded on bureau. In last 5 years, the builder paper had made massive progression in India. From an 80 lakh trade record in 2017 or 18, we are now at 4.5 crore of trade record. If you combine the three, then MSME financing in India can be near to consumer financing. So on the day when you have to figure out an assessment method, on the day when you have to figure out whether the customer can pay or not pay, machine can eventually be able to tell you that whether this customer, how much he can afford, how much he can repay, and at what price he should be given loan. We are at the early stage of that journey, but it is happening at a very fast pace. What has happened to the payment ecosystem in India? This progression is faster than that. Even if you look at UGRO's progression in the first 1.5 years progression versus what has happened in the last 2.5 years, once it gets set that it explodes, and our belief is that it is on the verge of exploration. Second very unique thing, and that's where the Ministry of News is that of this 90 lakh crore of credit gap, actually this credit gap is represented by one customer segment. Customers which are on the turnover band of 15 lakh to 15 crore. Now what is unique about this customer? It is not a customer which is able to credit. It is not a customer which is very well serviced by the banks. Banks continue to service MSME which are 50 crore, 75 crore turnover band because their OPEX and the ticket size actually justify their existence. This is a customer wherein the transformation is at the fastest pace. This is a customer which is generational shift is happening. Younger people are owning these businesses. This is a customer segment where they are really adaptable to GST. They are open to put payments on digital ecosystem. Their repayment behavior is getting norm. And this is that's why this represents almost 90% of the total credit gap. And this is a customer segment for which we are building as a large institution. Because we believe that within the credit framework, because the 50 crore people, 100 crore turnover, anything our view is that it was squeezed. Because large corporate is now going downward, and new credit is not being able to grow. But this segment of the market will mature exponentially, and if you are a provider of credit, then you can build a large institution around that. So that's the large theme. MSME will grow in India. Governments would enable the credit and would support MSME because they generate the employment. Greater ecosystem would become the core hypothesis like reservoir financing. The majority of the credit in all segments of the market will be done through data, and one customer segment represent the largest gap, and we are building a large company around it.
Anuj? Hello. Thanks, Shazim. So, what we've done is, there was this, we had divided the presentation into 3 sections, broadly. The underwriting section, how we have used data in technology for underwriting. And through that, a central theme around which our asset engine has been structured. And then the liability engine, which Kishore will talk about, and then the quarter numbers. So that is the flow. In next about 15 minutes, we will cover that. What we will have observed for the last few years, and some of the slides also mentioned that, through the constant focus of the government on MSMEs and the parallel evolution of the data ecosystem, more and more MSMEs are becoming formal. So the traditional primary and underwriting to MSMEs was that we will give data to underwrite on. But what has happened last 10 years is that if you have to be eligible for any government scheme, then you have to have a unique identifier and you need to have a digital footprint. That evolution is what will really bring the MSMEs to the fold. And institutions like us, who have invested in a platform which can ingest that data, are likely to benefit more. Just a little bit on what it really means, and some of the numbers you know, that the sheer member and GST registrations, the local registrations, and the other visible ecosystem parameters which have exponentially gone up in the last few years have really enabled the machine level kind of a platform to start helping enabling underwriting. But to do that, first, the problem had to be solved at the design level. And when we were on the drawing board about 5-6 years back, we said that if we want to be consistent underwriting and a predictable credit cost performance, then we have to group the addressable customers within our chosen target segment by sectors. So we worked with Kishore before we advanced, and we picked 8 sectors to work on. And then later on in our journey, we added a 9th sector. So till today, we only focus on those 9 sectors. And what has helped with that is that because the eligibility in cash flow world, other underwriting rules are able to predict the behavior of the customer in a much more accurate way. Also, and people keep talking about GST, banking, and they have been there sustained by GST, not that much. But none of the other players, other generic lenders were able to customize where they want to see fairly chosen target segment. What the difference which we have made is that we have combined sort of a tripod of GST, banking, and behavior for our chosen target segment, which is MSMEs between 22 lakh to 15 lakh turnover, and have been able to put up a framework which consistently is able to predict the client behavior. This is what is the advantage which we have. It is not a sustainable advantage because everyone else also has that data, and due to people will start realizing it. But that will sustain us is the commitment to keep investing and keep making this framework sharper. And so that how we want to do that is I'll talk in a minute. Why we are so confident on what we have done so far is because we have lived this journey for the last 6 years. When we started, we segregated the customers by sectors, and we were only looking at the repayment behavior as a medium to underwrite. Then during COVID, we said that why not also look at banking behavior? Almost every vendor looks at banking. That's from that from eligibility perspective, but not so much from the behavior perspective. So when we said that we will add the banking behavior to show, and this happened, this will be in July of 2021, just post-COVID. And last year, we added the GST behavior bit. And you will appreciate the delivering invest on the scenarios can be a post-mortem of the customer. So when a customer comes to say any lender, the lender purpose to look back and see how he was prepared and the moves which he had taken with other lenders. Now that is something where an event of default has already happened. It is a good way, but it doesn't cover everything. It doesn't have a perspective in the future. When you add banking and you add banking behavior, you get one iota of little information on where people rightly because the cash flow are looking stressed. And the moment you add GST and the moment you see whether the sales are in stress or not, then you get the complete picture of an event first it has happened and the event which is likely to happen. That we have done, and now the data is quite proven the last 5-6 years, we will be able to successfully combine all three in a fair life of machine learning platform where we will spell out about 25,000 features and let the machine decide how the customer would like it to be. We keep testing that for AI customers, whether the risk factor which we had assumed is there or not, and so far that is still none. The results are very, very encouraging. What is likely to happen now, I'm going to have just a glimpse on next few years and where we are investing, is we are allowing the machines to also guide us on what could be the anticipated operational pitfalls when the COVID-19 will reach the customer. We are a very simple rule, and then we still continue to do that and to believe that. Then that all the data machine learning is eventually an enabler. It is not an end to itself. So we will not learn to the customer unless a COVID-19 will reach the customer. And before he meets, the machine will recommend. But the decision has to be after we reach the customer. But now the journey is can machine also preempt what kind of questions you can ask? If I am in a pharmacy, hospital campus, or whether I am a pharmacy on the highway, these two have two different pharmacies, all the group are pharmacies. Should I ask different questions when I need the pharmacy on the highway versus the pharmacy which is in the hospital device? Some of the answers will start coming in when artificial intelligence will start getting built up there. We're investing in that. So the idea is that after a few years, all the financial analysis can be done within minutes because like that is available with a click of button with the machine learning platform working on behind, and also the time which it normally is taken to meet the customer and ascertain whether that touch and feel is okay or not can be considerably shortened with the AWS machine. So this is the part we are taking. Stand behind that, with a written detail, the real idea is to actually to archive the data which you're having and design the framework in a way so that a scalable platform can be made. At the base level, the problem with MSME lending which most lenders felt, there's not high credit cost. It was unpredictability of that credit cost. So a credit cost is a function of risk appetite. And you can take as much as you want depending on what kind of margins you're earning. But the standalone line, in few years, it has gone way beyond what the budgets were. So the real idea here is to use this machine learning platform and the data which can be registered to be a little more predictable about it. And so far, we've been able to do that. This is a little bit doing, but experiment which we started few years back, and we continue to do that. When we continue to check our growth store model, which is the interim relevant feedback which I was talking about, even on the rejected customers. So about 30% is our approval rate. Every 100 people that might get name. But this other 70 also, we keep checking how they are doing with the other lenders. And we find then that other risk score, which relative of risk classification of people, still works even for the rejected customers. And this helps in a way to sharpen and get more and more accurate as we move forward. So, yeah. Okay. This slide talks about our UGRO IT application landscape, or I would say IT strategy. Okay, my friend Anuj talked about a lot of data-driven approach. We have tons of data in our system, tons of data through integrated partners, and we have multiple products, right? So this came to an IT strategy. We should have an IT system which can cater to, there's a requirement with a high scalable environment, agility, speed, and high availability. So if you look at our middle slide, these are all 5 user-facing applications or partner-facing applications which are in-house developed. It's an IT strategy which talks about, okay, these are our in-house applications which we would be developing itself. Okay. And if you look at the last layer, it talks about complete ecosystem of API partners. Okay. With the multiple, backup solutions available and a lot of data which is highly available in the market. Okay. Those integrations UGRO has done, and all that data goes into our data roots, which talks about a lot of predictability, which others talked about, predictions, right? And of course, future, cross-sell opportunities, all that. And of course, all that should be highly available. And all that we have put in our cloud. Okay, so it can be accessed from any time, anywhere, by your user, even partner, in a much secure environment. Yeah. Thank you.
And I will take you through Glass of the Woman. The third Glass of the Woman, we heard about the alternative. We've heard about our before the very ecosystem, our progress on the data piece. And we're the more extremely high-end tech stack that allows us to build our asset engine on. But one simple philosophy as the asset engine is to clever a lender to provide credit as in USME, to solve for every credit need as in USME, which means that what this lender is building a diverse set of product. So if you look at our product suite, we have a 27,000 rupees 7 being working capital for a retail finance, with a 15-year secured loan sell in MSMEs. A loan secured against property as a collateral, against equipment finance as a collateral, or non-collateral loan, where it's secured against receivables. All of that has three things. One, our data engine, which is the base for 3, and second is that tech stack. That was pretty. And so, when speaking of these diverse suite of products, at least in our minds, there was no other institution, and MSME Circus Institution, that has such diverse suite of products. And I will tell you why I will say this. When I talk about the diversity needs of these channels, how we did these products to market is essentially sale asset engines. The first is the prime asset engine as we tell it, where we deal with both against property and business loans. This is essentially intermediate channels in the 30 cities that we operate in. The second piece, and this is our focus area, and we'll keep hearing about this with many creators and throughout the lifetime of UGRO, is our newest focus channel, which is the micro enterprises business. We were at 75 branches beginning of last year. We closed this year at about 150. We were 2025 at about 250 plus branches, and 2026 we were at 400 branches. This is where is paramount AUM largely. This is where so shifting our AUM mix towards doing higher volume micro enterprise secured loans. That's why giving us a large distribution reach across the country And third, we will need children who will get towards where we will see 40% of our income coming from this business. The third channel is the ecosystem-based channel where we do asset financing and green asset financing. It's an important channel for us because we are one of the players amongst very few who live this space. With word of maturity, and I'll back in word of maturity when I talk about the peers. Third, the third channel, which is our direct and digital. So we have about 75 partners whom we work with. We do spreads everything from a micro secured loan to a reserve-backed financing, ecosystems from e-cram players to delivery partners, and now with the acquisition of MSME Wealth, allows us to meet with large number of systems where we can give checkout financing to our partners. So if you look at the entire asset engine, and if I were to look at the pillars which we work in these, the first asset engine are PSLs and large NBFCs, the banks, and will be with the properties, the business loans, and compete with them. And the second piece, we have the micro enterprises partner of the micro enterprise institutions like the Verostas, the Star, the 5 Stars, the UFCs, and this is where we are focusing on now the last where the third piece is where very few listed players, but really it is the electronic players and the cements who when the market were at now, just being 5 years of the system or practically 3 years of application are almost as big as players who have been in this space for 20 plus years. And third, and the fourth, as well as those where the fintechs and other distributions play. So if you really look at what is being built, is a convergence of 4 different solutions being built in one. And that's why we say that not only does it have a diverse suite of products, but also a diverse asset engine to service every need of every customer. So, we started a micro enterprises business. We started with 5 states, where Rajasthan, Gujarat, Tamil Nadu, Karnataka, and Telangana. We really have presence across the country. And this is really unique. I have proudly served with one only enterprise which has a micro enterprises business and micro enterprise branches across the country. We have certain players who are site focused, we have certain players who are central focused, Rajasthan focused, but where he's able to crack the code across the country, and ICTs, we've put our balance into it to create this as a pan-India distribution. There are people like us with about, we should be 250 plus branches in 2025, 400 plus branches in 2026, continuously growing our asset footprint. And this is on back of our asset related, on back of our own and anchor partners on our ecosystem business, our blue partners on our intermediate distribution, our fintech and our alliance partners and our digital alliances business. And nice to interview about 3,000 people who are in ground circle every bill. And so members is out there and this templates people are amenity to diverse respects. Across the 9 focus sectors that we have, service every customer need with our conversions and communication of our union partners and brewer partners, our alliance partners, and a set of 3,000 people. So that as an engine continues to parallel on these stairs, build on a really tracking pillar as liability. So based on the 2-to-1 and the liability to that, I'll call upon Kishore Kishore.
Thank you. So prior to 2018, in NBFC space, leverage was the key. So 6 times leverage, 7 times leverage was the norm of that time. If you can generate about 2% ROE, then you could easily deliver 13-14% kind of ROE. But post 2018 for new age NBFCs, this 7 times, 6 times, 7 times leverage was completely out of window. So now we can new age NBFC till the time they have large parentage or large and long vintage, you can leverage your balance sheet 3 times, 3.5 times, 4 times. Beyond that, it is very difficult. But at certain times, delivering the ROE that most of the people in this house would expect is difficult to deliver. So if you have to deliver 16% ROE, 18% ROE at 3 times, 4 times leverage, it is almost next to impossible. So how do we solve this problem? So we have solved this problem through a unique liability strategy, which is co-lending, which we have discussed in our earlier session. So almost 50% of our stated objective is that 50% of our balance sheet should be off balance sheet. As of now, we are to 45%. So effectively, we leverage our balance sheet without leveraging. And it also solves two other problems. One is the liquidity. At times in last 3-4 years, we have seen enough cycles where liquidity for NBFC has been a challenge. At times it has come very quickly. At times it has been very, very difficult time. We have seen post DHFL and era also, post COVID era also. So it gives you a consistent liability flow in the system, which helps your ascending into generate assets which it wants to generate. Also, it helps us to cater a segment of customers who expect long-term loans. So there are customers in our prime sector segment who expect 14-15 years of loans. If you are an NBFC, getting 14-15 years of liability is not possible. So how do you solve this? That is 80% of this asset can go into, or 60, 70, 80% of this asset can go into co-lending. Then from capital, which is required for 15-20% annual capital is required, you can solve this problem as well. So co-lending is helping us in terms of our overall liability strategy. And if you look at this slide, you have all our products are demonstrated. Most of our products are designed in such a way that they go into co-lending. Now you understand that what banks expect. Banks also understand our origination strategy, our collection strategy. That is our prime security, almost 52% of the bills are balance sheet. On business loan side, in fact, almost 2/3 of the book is off balance sheet. On micro enterprise side, almost half the book is off balance sheet. Supply chain is not designed is such a product which is not designed towards co-lending because the tenors are too short. For the comfort of the co-lending, MSME financing is almost 42% of the book is co-lending. So entire asset engine is designed in such a way that we can reach our target of 50% of balance sheet. In balance sheet borrowing also, we are quite unique in terms of our set of lenders that we have. So in 6 years of our journey, we could attract most of the mainline lenders who matters in this NBFC's group. So from large public sector banks to some of the largest private sector banks to some of the largest global DFIs and lenders. And if you see that this chart, that 41% of our borrowing is coming from banks, only 10% is from NBFCs, or almost 30% of our liabilities are coming from large DFIs like ADG, FM, responsibility to microwaves, etc. So in this kind of unique liability structure, you would not see in some of the even the largest of NBFCs and some of the new age NBFCs that are being monitored very closely these days. All this will lead to what we have reached on this and by this time that we started with an AUM 79 crore in March 19, and now we have reached an AUM of 9,218 crore by June 2024. This is the disbursement trend. We have been disbursing consistently closer to 500 crore a month till March. June quarter has been a little slower to us because we have slowed down on our supply chain book. So we have run down our book by almost 200 crore. That is why you see a dip in overall net disbursement. If you remove that, then we are closer to 1,350 or so, which is closer to what we were disbursing. April and May has been slow for us, but June again, June and July, these the months have been good for us so far as disbursement is concerned. And AUM we have already spoken to. This is that very stable asset quality, which Anuj has explained earlier, that our stage 1 asset is 93%, provision coverage which is about 48%, 47% now. This we can, and the distribution Amit has already explained. And coming to the numbers, on quarter 1 we have a published on 31st of July. Our AUM have grown by 36% year on year from 6,700 crore to 9,200 crore. And the AUM has increased marginally from 43% to 45%. Net income, total income, you are seeing a dip because largely this quarter we have lower co-lending and direct revenue, which are related to lower net income. And overall profit has increased by about 20% from 25 crore to 30 crore PAT. Cost to income ratio is consistent about 54%. ROE 1.9%. This quarter we have raised equity, which have resulted into lower ROE compared to the previous one, which is 7.7%. This we can skip. I have already explained that how the quarter have gone by. And all this will lead to a journey which we have embarked upon, that to reach a 5% of ROA. And how we achieve it? Last year we completed the year with 2.3% of ROA. With the expansion of our micro secured vertical, where we had 75 branches till last year, now we are closer to 150 branches, and by year end we will have closer to 300 branches in total, over 250 odd micro branches, and next year we will take it up to 300 to 700 branches. And this is a high-yielding secured business where we see significantly high yield on the product, and also in supply chain side we are getting into the retailer and distributor side of supply chain where the yields are higher. So all these together, we are expecting the yields to go up by 150 basis point in next 8 quarters time. Cost of borrowing should decrease by 75 basis point. It is a factor, 3 factors. Once it is a factor of vintage, it is a factor of rating, and we are also expecting a rate cycle to come in by the end of this year. All these 3 factors, recently we had in rating and rate. Now we are completing 6th year of operations. Gradually it will help us to reduce our borrowing cost, and also by the year end there should be a credit lower interest rate cycle which should reduce our borrowing cost by 75 basis point. Operating leverage is kicking in as we grow our AUM, which we have shown demonstrated over the last 3 years that how we have went post-COVID from 1,000 crore to 9,000 crore, which should save at least 50 basis point on operating leverage side. And as the asset category matures, we expect that borrowing cost should go up by 50 basis point. All in all, there should be change of over 250 and 40 odd basis point on ROA, and net of tax it should add about 160 basis point, which should convert into a 4% ROA in about 8 quarters from now. So, and all this will lead to a sustainable growth of 30% year on year, where we are going faster, but after a certain point of time, the sustainable growth will be about 30%. As good balance sheet, as we explained, that it will be 50%. Cost to income ratio, as of now, we are at 54%, and we are expecting better by scale grows up, it will be around 45%. Credit cost, as of now, we are about 1.5%. We expect it to be 2%, 4% ROE, I explained in the earlier slide. And if we leverage it 4.5 times, we should be closer to 18% as ROE. With this, we conclude our presentation. If there are questions, we will be very happy to.
Well, tell on soon. And why is the big for the change? It's one of the other things which very quickly I'll take you through is that one of our beliefs is that great financial institution in India and worldwide is also a function of governance architecture. Our belief is that democratized ownership, independent governance, and professional management tool, which is incentivized well, both finally lead to creation of a large institution. Among the banks, if you look at it, all of them are mostly in that form, right? With NBFC, we will actually except 1 or 2. Large number of NBFC are largely corporate owned. But over a period of time, whether they can convert into a large institution, some of them are already or not. Our hypothesis is that, so this is first assessed.
So, let me check.
First is our ownership. We are a completely institutional platform. So, we have 10 boards, we've done 3 rounds of capital raise. It was a first listed startup. One of the reasons that many of you have not seen us or not tried us because we will have the opportunity to come to an IPO vote. We believe that to start a company in gold advice on transparent listed format is a better option. So in 2018, we acquired a share listed company. We did our first round of capital of 950 odd crores. In which 4 private equity investors participated. In 2023, we did our second capital raise of 340 crores, which one of the world's largest DFI participated. And recently, we calculated to 70 odd crore of capital raise. A very large number of family offices when one of our existing investors participated. On a fully diluted basis, this is our ownership. And our aspiration is that we convert our capital structure where long holders
public market investors, and people in high level all are part of our growth journey. So, when a people, ISU, which is the Denmark government arm, which is sovereign investor, is 10.5%. PPG request is 10.7%. Our initial investor, PEZ, which was an early investor, was fully considered. VDB, which is a $3 billion private equity fund, as Asia is 10.5%. Sabina in this round because we are putting 500 crore capital in the 70.9. Sabina is an initial investor, a permanent capital structure private equity fund, and we have around some 800 public share, 800 number in public shareholder in 2018. We also 48,000 retail shareholder. The management team is also a large participant of the capital structure. So management team would roughly own around 4.5%, which is in form of ESOP. Our ESOPs are actually structured very uniquely. So our ESOPs are not compensation structured. They are designed to incentivize management to be aligned to the shareholder interest. First time for a lending company in India, ESOPs are designed that they invest over a period of next 2 years, depending upon the achievement of price. Our belief is that if we do well, you would reward us, and that will get reflected in price. So management should benefit only when shareholders are benefited. Very easily done was our first time. Second is, as I said, we are institutional and we are independently supervised. At the time of the inception of this company, they said, how do you create an independently supervised structure? We said, if you create an architecture, if you create a charter when the company is always independently supervised, when no one has one unit, people can have three, but nobody can direct the company in the same way. The only way to do is that we provide you with our articles that the majority of our board would be independent. This company will not lend more than 1% of its net worth to any customer. With skill management, is hiring and firing is in the hands of the management, the board itself. And any shareholder is through primary route invest more than 10% of the company automatically become eligible for a board seat. So which means that we'll have two sets of people. One who makes sure that the superintendent governance in hands of independence, but it is not a free in the company, which means that shareholders, large shareholders which represent all shareholders' interests also have a view and focus on value creation for this. And if you look at our construct of our board, which has changed over a period of time, but we have tried to create an institution which actually governs from a governance perspective, represent the voice of large stakeholders. Our chairman is a retired bureaucrat, very well known, ex-CLC Government of India. He was chairman of MCX on its crisis time. We have Karnam Sekhar, ex-public sector banker. As you know, the public sector banks are large provider of credit to NBFC like us. So, SBI banker, we have our ex-LIC chairman, we have X number of siblings, so everyone allowed. Mr. Karupa Sami works of RBI. Because we are a large participant on public market side, the also have been rated analyst for BFSI for at least 2 decades. And the shareholder nominee, which are more than 10%, are also on the board. So that's our governance. And the management, as I said, that we were still in the first year of the management. But we have to make sure that we have invested into the second and third layer of the management. We are fair asset run by fair, unique individuals, and of the large 25+ years of experience. We are very focused on data analytics. We have data analytics. We have, for every vertical, we have chief credit officers. We have co-lending, so head of co-lending, whether it is collection, fraud detection, operations, brand and communication. So we have pre-invested into management, and all of them are towards value deliverers. So all of them have the option to go to large corporate team, NBFC, bigger banks. That the common focus to create an institution is a common vision for this management. This is not my vision, this is their vision. And because they are participating, and we will benefit when they create that institution. So on this, we open it for questions, and happy to answer it. All those questions here. So, Mankarit?
A main spec basically.
A main one?
First thing. Anytime.
So, just get up quick and get open and see him. Okay. Night will and get mics.
The fourth.
Go ahead.
Likes, Nath, likes this. How many likes? Distribute. What happened there? Nothing. Here is that one. Bishop is this gentleman? Yeah. Yes, so please go ahead.
So, I'm sorry, I think somebody else was there.
Ron, please go ahead. Okay, please go ahead.
Yeah, so I think this is a question which is in everybody's mind that, on the one hand, you have a co-lending model, which is by its nature very capital efficient. And on the other, we recently raised a large chunk of capital. So if you could just elaborate on that reason behind those.
And also in the mind of our existing investors, that why you raise capital when we are actually we're not valued, then we should be valued also. Also, we find those back to Brits, your existing investor plus prospective investor. So look, capital has to function. Our capital raise is for the balance sheet asset. So it is, so if we want to report balance of 50% and then we will grow this capital for next 2.5 3 years would be for the balance sheet capital. Now the way the capital functions, why you raise early capital in a liability business, it's a function of leverage and how your liability institution look at you. And it has a effect on our cost of borrowing itself. If you look at March 25, we exited at roughly around 20% of capital adequacy ratio. Theoretically, you can go all the way down to 15%. Do you want to go down? So that is the dilutive effect. Or you want to raise capital and recapitalize, to go back to 28% and come down again to 20%. We always say that our liability partner or cost of borrowing impact. So we said that our expansion of our 75 basis point cost or borrowing becomes is a function of early capital. And when the market is still really tight, we always want to not go on the borrowing, but want to raise early capital. So what it gives, so to when I'm sitting over there and this is one of you, our company doesn't need any more capital for next 2.5 years. Which means that we are in a very safe zone for the sport of our growth. We are convinced that the micro enterprises economy, especially in that 15 lakh to 15 crore segment, is performing very well. Our data shows that their resilient credit cost is not a challenge. And if you want to continue all the growth and want to fight that battle, you want to raise that capital. Or whether we will read it on a continuous basis, answer is no. Once you get, once I teach will cross 26, 8 to 10 quarters from now, the accretion of their net worth, which will start happening, will start reducing the need of the capital. Lending businesses always need some capital because growth in India is always 30-35% versus capital accretion happening at 15-17%. So you always have the gap. There are other tools also which we can use. We have not used it. So theoretically we can do that too. Theoretically we can increase our pro-lending from 50 to 65%. But as a management balance, should I increase from 50 to 65% and not raise my capital? What would an SBI would think about this? So no risk is that SBI would think that this company is struggling for capital. Should I? You heard from the panel. They said we look at the entity risk first. So whether they will start worrying about the entity risk and our pro-lending will start coming down. As soon as you raise capital, the rest of the thing, which means our net liability raise, cost of borrowing, co-lending, all of that will start improving. So when we convince our shareholders, we serve a dilutive effect versus what we deliver on a post-judicial basis will be far superior.
But you're putting we
just for few quarters, sir.
I don't think it will be a new quarter.
No, so we did. So we said, no, so depending upon the time horizon, we said in 8 to 10 quarters, we will get to 18% ROI. That's a very main statement with our company, right? So we are saying we are going to deliver on that. So obviously, our capital came out in this second June. We are just at the beginning of August. So obviously, in there we will do bad. But so we add 3,000 crore of asset in last 2 years every year on an annual basis, and almost 50% of that on the balance sheet basis, which means this year, here onwards, minimum and that much we will add, but given the capacity and number of branch expansion, we would add more asset, right? So if we add more asset, and even if you put 50% of that asset on balance sheet this year and 50% of that on next year, with the full leverage, which is on and off balance sheet. And if we get to a 4% ROE, full leverage on and off balance sheet would deliver with that ROE.
So I had a follow-on question, but this is more of for every industry as a whole, and maybe you can comment from your vantage point. Of late, one has seen over the last year, or maybe over the last 5-6 years, the RBI getting progressively more stringent. It's almost as if that safety is more important of the system than the growth of the banking system. That is the impression that I get as I look at it. Within that, there seems to be some kind of attitude towards NBFCs. I mean, conversationally when we chat, they say, no, RBI is against NBFCs. Perhaps they want to sort of make sure that NBFCs remain small in preference to banks. So if you could comment on those.
So look, I have been in financial services started from 1899 to 2024. I think three different dispensations of our world and an approach towards NBFC. Good thing is that in last 10 years, NBFC are a necessary imperative for credit dissemination. There is no doubt in anyone's mind. It is, so for example, Ministry of Finance called the entire NBFC industry some times back, set up a co-lending committee to increase the co-lending volume from current 1x to 10x. They called us a deal in 2 weeks time from now. Are there also rules, I think so what narrative you see in the press? You also have to look at some of the RBI reports which has just been published. The RBI is clearly saying that for underserved and underserved market, NBFC are the necessity, without them that would not happen. That's the first thing you should presume. Now, on top of that, what is RBI saying and what it has always been saying? Why you have got it because of certain action of RBI and certain statements, how the governor speaks, I don't know how the deputy governor speaks. RBI has been very consistent when it comes to the banks or NBFC. There are 4 things RBI says. One, in unbridled growth for every lending institution is a recipe for disaster. Now, the unbridled growth is undefined. It varies. Bajaj Finance in India have grown for last 22 years up to 37% CAGR. But that's for Bajaj. Not really necessarily for any other institution because they may not be able to manage that level of growth. Number 2, the biggest concern of RBI is of systematic risk. What is the systematic risk? The biggest systematic risk is you who put money in a bank deposit. Bank has to use this money to give different form of credit. Bank has been giving this money to large NBFC. Large portion of the bank credit to NBFC in last few years have gone to AAA and AA+ and the public government over NBFC. But finally, what was the end use of that money? The end use of that money only for largely one sector. Retail credit, not MSME, retail credit, consumer and the personal loan segment, sub 1 lakh ticket size. Wherein RBI problem because they see aggregate data. So in their judgment, when they saw the aggregate data, they realized that lot of new generation, new type of borrower are actually not repaying the principal but only refinancing it. Where everyone, so a bank has lent to a large NBFC which is partnered with a fintech and finding one funnel to a consumer credit, which means I borrowed 75,000 rupees for going on a holiday. Now I borrowed from second lender and I repaid from that and I borrowed from third. And that is, so RBI worries about this systematic risk and not that they are empty NBFC. That is not true. Within that also, and we also keep saying that it should, if you look at if that be the case, microfinance industry, which is technically the highest risk spectrum of credit, has grown on the basis of what they have been doing in dispensation or categorizing NBFC over 5, housing finance and categorizing NBFC housing finance. You don't see are they ever see microfinance in that for you, right? In all of the risk rate which RBI proposed, it will increase for risk rate for microfinance industry. If there would be the generalization of saying NBFC are bad, then MFI would be the first one to get hurt. So I think you should, look at this on a self-construct basis. In our opinion, when they look at people like us, and they also draw comfort from early capital, saying, we don't like lender institution to grow disproportionately. Our comfort zone is in a particular region, but if the company has capacity to raise capital early, which means if for something to happen, they will be able to absorb the share, they are fine with that. So NBFC are here to still. Banks, in my opinion, will continue to grow in the range of 15 to 16%. Banks would remain relatively in leverage business, so ROAs of banks would be in the range of 1.2 to 1.8%. NBFC would go into low leverage, but within a high ROA, and the collaboration between banks and NBFC would increase as the time would pass. Yes, please.
So, this is Ramesh Purvani from Mehta and Vakil. The 3 hours we spent, you have encapsulated your entire journey. Raising your AUM in 2018 from 79 crore to 9,200 crore was a remarkable feat. I don't think any NBFC or any private, any other one, even a bank, private or public, will match this kind of speed or accelerating, but very, very calibrated, very, very calculated, and a very, very solid growth you have delivered. It is full marks to your A, B, and C team who work day in and day out. Now, the thought which came to me was, how much is microfinance a part of your AUM?
So, zero. So, I was to clarify. So, we segment the market, right? So, we to do first thing, we target a customer segment which is in third. So, we are a pure business loan company. 100% of our customers are MSME customer, which is the any part of it. But we focus on customer segment which are from 15 lakh to 50 crore turnover. When we say micro enterprises, we are expanding to tier 2, tier 3, tier 4, and now tier 5 geography, which are basically small retailers. A shopkeeper, a baker, a small factory, a fabricator. And where the credit is difficult, where you have to assess the credit, you have to have a physical presence. That is difficult business because the repayment behavior and assessment and the collateral have always been challenging. And your level of data and digitization actually starts failing when impact starts failing, what it data you can achieve. So that is to do that business, which is the average ticket size of around 10 lakh rupees, secure loans, secure against hard collateral, which can be self-occupied residential property, commercial property, so on and so forth, at a portfolio end of around 19-20%. Currently is around 12% of our AUM, growing to 40 to 36% in our next 8 to 12 quarter, which is a sheer function of number of physical infrastructure. It has taken us time to learn that business. It is in India. If you go to deep Tamil Nadu and you go to deep Rajasthan or UP, the collateral itself differs. Yeah. How do you look at the collateral, the title, the verification on? So, say a company headquartered in Mande, we run 55 types of collateral policy, right? We run around 100 types of assessment method because there are 1,000 types of business and all that. So that's why we experimented in 2022 with 25 location, and that was very tough. It was very tough journey. Then it took us almost 19 months for our first 25 micro branches to break even. Then we added another 50 branches. We're breaking even in 15 months time. And that gave us the confidence. One, our other line of business has provided us the minimum threshold profitability, which means we could invest further. And now, having done all of that, we are accelerating that. So we added UP, we added Europe, we added Maharashtra and Andhra. I'm in Banaras, but I was always negative on UP. But some of the those states are actually now progressing extremely well. And that's why we added the geography. So first company which has their capability are north and south. So this north and south divide was very difficult to fulfill, but that's why we are moving. And we are very confident. So one belief is that if you lend at 20% secured, then your credit cost will be very high. But if you, so all of the growth which you transfer, all the appreciation, but believe me, that's our almost last 12 to 15 quarter, our real growth is when indeed we disburse 30% to all the logins. So for a 500 to 600 crore a monthly volume, we generate almost 2,000 crore of loan origination every month. 50% machine visits, 20% our credit officer visit, and then only 30% will disburse. So we have been able to maintain that growth while we have been able to maintain that quality. Our belief is that micro enterprises will be able to replicate, say, high yield, secure, but lower credit cost curve. And I think our performance show that degree of resilience.
So the second question or the second thought is, on a full AUM basis, what is your cost of finance? That is, what is the rate at which you get the money? And second, what is your realization of average realization or the composite realization of the lending? So that will give us the NIM.
So the composite realization of the overall book is about 16.7%. But 16.7% is the composite realization balance sheet overall AUM. 45% of which is our book. And our cost of borrowing is about 10.5% on balance sheet. And off balance sheet it would be slightly less, maybe 60 basis point over.
So safe to assume that the net interest margin is 5%?
Safe to assume it is closer to 7%. Because there is 20% capital involved in it. So its cost of fund will be closer to 9%, over to 9%.
Excellent. And it approves, but going forward, this at least will be maintained or it will be improved.
Yes, of course.
This is a feather in the cap the way you work, and having SBI as a banker or maybe vertical banker or a vertical support, there is no doubt about it. Thank you and all the best.
Yeah, please go ahead.
So, sir, I believe we need to put lesser capital, that is 20%. But with respect to operations, it should be a very operational business, and especially one of the items that is collection. If my understanding is correct, we should be responsible for 100% collection and not the banking partner. So what is our thought on building collection stack and how we have built so far? And that will be a total collection team size of the total 500 people. So we talk about the collection infrastructure and how do we cover the cost throughout it. But look, our operating infrastructure is neutral in how we fund the balance sheet. So if we originate 600 crore per month and we collect 600 or 300 crore per month, the front line, which is the credit, the collection, the distribution of the sales force, the technology, how do you do the funding? It has got nothing to do with that. Actually speaking, for the same operating OpEx or infrastructure, when you pay people who are not putting the capital, so the same 7.5% of interest margin which I earn, so if I have to provide capital for that, then it is not ROE related. So actually that is why it is more efficient. But if you want to take collection infrastructure, how it operates? Yeah, so we have a very large collection team, and the philosophy is that for MSMEs, collection needs to be physical. Our underwriting and onboarding is digitally aided, but the collection is physical. So we have a very large collection team first. We have divided the collection infrastructure into broadly 3 parts. One is the soft collection through call center, where the data is fed from analytics team on the early warning system, and depending on what kind of categorization you have, the intensity of the call and the field action is decided. The second is the field collection in the branches, depending on what kind of buckets and the products. And the third is a very separate litigation team, where because most of the LUCD collection, especially if it is secured, is primarily basis the litigation milestones. So overall, the philosophy is that we will have a large collection team, which is technical in nature. Okay, and what about the size, sir? So currently the collection team size will be closer to 425 people. Okay. My second question was towards the competitive intensity of it. We have been hearing from a lot of players, for example, affordable housing finance companies are also talking about this micro segment with the name of micro in that, where we are also focusing a lot, where they are also talking about lending to MSME with a ticket size of 8 to 10 lakh rupees. So, and non-affordable housing, so across the segments. So, where is our right to win other than tech? Because I guess a lot of players have developed tech, and they're talking about the tech superiority. So, what is our right to win, to winning? What that kind of grades or becomes 20% of our portfolio?
So first and foremost, I talked about the gap, right? So if for this 90 lakh crore gap, and of that about 90% between 15 lakh to 15 crore per work, almost I would presume 30 lakh crore would be fair customer below 1.5 crore turnover band, right? But 50 more lenders or 75 more lenders in India is still there will be more demand. So if you think of this, you travel fly to Jaipur, and from Jaipur you travel to say Jodhpur, right? And you cross number of cities and you see number of new shops, new trees, new stone cutting businesses getting created. Everyone needs credit. So you have to believe that reach is the most important factor to win the business. Second is understanding of customer and understanding of the collateral is the second most prominent factor. Why after so many years of existence, largely remember Rajasthan North circles, because the cultural aspect of doing business in Tamil Nadu is very difficult. So as if you look at a 5-star, which is a Tamil Nadu and Andhra company, have not succeeded in it, they will eventually. Or Equitas of a small finance bank have no presence in Rajasthan, or a capital small finance bank continues to be a Jalandhar bank but has not been able to go to that. So this nuanced understanding of customer, collateral and assets, is the holy grail. I don't think so the quantity issue matters. For a 15, 20, 30, 40% growth, if you can maintain expansion, if you can understand each of the geography, and if you can maintain the credit quality, believe me, all of affordable housing finance companies which are going gravitating towards small ticket lab, all of the micro lab companies which are only 3 lakh rupees ticket size, all of them would grow. Winners would be those who have right architecture, combination of data, technology, right sets of team and process around it, which will take the market share.
Oh, understood, sir. So one more question for excuse in. I read that we were 9 banking partners, and one common thing about one is all of them are BSU. So how important is it to get it or have a private bank as a partner, as a preventing partner, or it hardly matters because we can grow with public sector and it doesn't need any private sector bank to be on?
So we have started with both Karnataka and Kerala, but Kishore is going to answer that.
So, look, if you look at credit history, public sector banks are your largest credit provider and long-term partners. So there is no doubt, second doubt in our mind that the sustainability of relationship with public sector is always very long-term, unless there are near groups, they were to stay in all weather. So they are only the friends, public sector. And especially when you integrate with them, they take time, integration, policy formation. But once they are on board, they remain with you for a long time. Right? And clearly, if you go to private sector bank, they think that they can do whatever an NBFC can do. So their expectation on NBFC is slightly lower compared to what a public sector bank would normally expect. So whatever retail they are generating, they think that they can do similar kind of book on retail and MSME space what an NBFC can generate. And also they think that they are equally superior in terms of collection infrastructure, which a public sector bank never thinks. So considering that now all the private sector banks also realize that the co-lending piece is also a win-win situation for them as well. They realize it a little late. Now some of the private sector banks are coming to this space and have started doing business. It is recent in the last 6-8 months. It is the speed in increasing, the volumes are increasing. So slowly they will come up. Once they understand the math, but without OpEx, without newer credit costs, they can generate superior ROI. They will also follow the suit, but they may take some time.
So, we talked about 2 things. One, and this is an important in India. government are pushing expansion of credit to MSME. Run with team for the government is the public sector bank. So हिंदुस्तान में कभी जनगणना करना हुआ कुछ करना हुआ तो finally government tells public sector banks to do it. Public sector banks are, if they have to achieve that objective of their owners, which is the government, then we become a natural partner to them. Now contrast that to the private sector banks. So take to 2014 and prior. Private sector banks, the largest lender to the corporate credit, were suffered from that with time. And because the public market then said, oh, you have to do retail credit, all of them have gravitated to massive retail credit. But remember, when credit consumer PL, credit cards, acquire multiple microfinance companies, what is happening? If you look at the top 10 listed private sector banks, given the ROEs are under pressure, deposits are under pressure, OPEX are very high, prices are not, share price is not going up, they are now realizing the economic benefit of the eco-lending. As I said, where is with person, look at the portfolio in by all banks. It is not more than 1.5%. Because the ROEs of all the banks, it is not more than 1.5 to 2%, right? Best of them. And they, because they can leverage, that's why they're at 16-17% ROE. But now they're realizing that it's good lending, and when you move at 15.5 and then net at 9.5 to 1% credit cost. So without OPEX, credit cost adjusted this at the 5.5% cost of capital, we are generating the best ROA performance for them. So private sector banks are now realizing the economic, while the public sector banks started from because they are being told to do so, and we were the very way to do it. Now they're also realizing that this is best way to lead the asset growth, and so as private sector banks are also realizing this is best way to lead the growth. And that's why we keep saying that, and that's why today when we call the panel, two of the private sector banks are there, which we are not partnering them, but most of them have started with some financial.
Understood. Thank you.
Also, my name is Prasavan from Electrical Brokers. So I have a couple of questions on the branch expansion strategy. So, sir, earlier on previous calls, so you had highlighted that our underlying philosophy was, first set of 75 branches and then achieve maturity. I guess the milestone was 75 CR per month. Then go for second round of 75 branches. Now in this single year only, we are I guess adding more than 150 branches. So my question was, is there any change of strategy from maturity to mid-affair, or covering the geographic distribution more, or I'm sure we look at this massive expansion
For this, so the philosophy is the same. Let me answer this question. So, and what you're right, and I'm happy that you're following with the rest of you saying 75 branches, 75 crores, and then we'll expand. We did put up the next 75 set of branches, which went live in late Q4, early Q1. The first set of 25 branches, and like Sachin said, took about 18 months to break even. The second set of branches took about 12 to 15 months to break even. We were question of 75 branches, 75 crores last July month's number for 150 branches that we went live in April was 127 crores. So, and why is this happening? There is no change in our strategy of distribution. The change that has been adopted is that, please realize I spoke about diverse suite of products. Initially, all these branches were only giving micro enterprises loans, which is about the 8 to 10 lakh. The more who are in these branches who are realizing that there are customers who also want a 25 and a 30 lakh rupee loan. There are customers who actually wants a rooftop reward. There are customers who also wants equipment finance. And that is our unique ability to be able to distribute those products from the branches, making them more productive and more profitable. And that is why our distribution numbers are also showing up, and therefore our expansion and the confidence in the expansion.
So, just if we look at our current number of branches is 164. We're targeting around 285 branches by March of 25. So, which is roughly
100 with branches.
120 branches, nearly 40 branches per quarter. Quarter you run rate.
25.
Yeah,
branches.
yeah,
That's correct.
to 30. When we look at, I guess on the employee expense addition and YY growth, it was nearly 48% in Q1. Wherein we added from 98 branches in 1Q of 24, we came to 168 branches. So when we are looking at reaching 285 the numbers by in FY25, how do we see the employee cost going in this
Financial year. So, please understand that largely a branch cost is 4 lakh rupees a branch monthly.
Listen, I don't know whether it is micro or
No, we are only expanding in micro enterprise branches. Use branches, then make it 6 sales, 1 branch manager, 1 credit manager, 1 ops manager, 1 collections. 4 lakh rupees, 4 to 4.5 lakh rupees is the overall cost. Or the branch including rentals, because these are the rental branches. There will not be only added cost of supervisory cost or any other operational technology. All these costs are already involved. What is now increasing is that is now going to increase are this productive people cost, productive manpower cost, and back to that, if the Butulan is now crunching from 12 months to close to 9 months, these will be extremely productive branches for us. So to answer, the employee cost will only increase for the productive people. That is not very high cost resources, and it will stay in line with the 3.5 lakh work.
And what is why we say that there is a 50 basis point of operating leverage coming while the headcount is going up from 3,500 people to 5,000 people. Which is the, now we have come into that steady state, within all of our 4 business line, if you look at this business line, it's a 20% in your secure business, 3% of fully matured credit cost, 3% of OPEX. So the ROI tree for both were to grow, and when the union grows from 20 to 36%, next year, the flow of cash flow will accrete massively to the company. Now, why it is going down is because we need that confidence of the geography collateral type no customer type. So what are 5 students? We are with very hard work, and so most of our peer sets, are in this range of 3 lakh rupees to 5 lakh rupees of secured loans. These are one other microfinance, we are more formal credit provider. Our customers, we do secure property, we do technical, it's a very formal type of credit, except but cash flow is an estimated cash flow, which means the credit officer has to go visit, look at the business and estimate the cash flow. So what the beauty of UGRO, and there is no other PSA in India, we have found that customer. I gave within this example that हम यहाँ बिंदी दामे बैठ के सोचते हैं कि tier 2 town मतलब गाँव है, but गाँव नहीं है, right? Or those 2 or 3 towns are actually very large economy, right? So I went to Rajkot, and Rajkot has 15 float towers in many numbers. So selling customer credit need across higher ticket size for assurance, for infrastructure work, and a lender were ability to go well. That's why we have now given the confidence that we can expand faster, and our OPEX monetization will also be faster because we are just not doing them that, but on a lower OPEX basis, we will be able to make per brand much faster business, and we'll be able to lower the credit quality as well.
So basis on this branch expansion, so our quarterly, monthly run rate was 500 CR disbursement run rate. So post this, branch expansion, the guidance which you had given in the past, like 700, 800 per month. So would you stick to that guidance, or would you like to revise on it?
So that guidance we are giving to people this in mind. So there were 2 parts of it: AUM growth and bottom line growth, right? So when we ended and raised the capital, we said we have to grow the AUM, but we also have to accrete capital and build profitability, right? So I can go from 700 to 1,000 crore if I start lending on secured business, a lower percent. There's no point in that for our company because that doesn't need to document the families. So the growth is in the silver range, but the growth is now much more profitable. What we are growing. So why we shut down the entire financial business? Our entire financial business was at a yield of 13.5%. Why we put this cost showing we will not be businesses other than the prime secured business below 17% or below 16.5%. Because for a company like us, it doesn't make any difference. No, our shareholder doesn't get rewarded. And also we saw that even higher in business, our bank partners are accepting the productivity co-lending, right? When we started our micro enterprise business, our hypothesis was best luck का secure loan Hindustan पर कोई बैंक co-lending नहीं करेगा. The fact is that now we see 48%, 46%, even of that portfolio getting co-lender. In fact, we are also shocked why it is happening. It is happening because we started on per person secure business, banks got comfortable with our credit quality, and now they say, please explain us what else you do. And what's your vintage, what's your portfolio quality. So I think so the Indian burdens will remain in the same range, but we are committed, whether it's 8 quarter, 9 or 10 quarter, we're committed to increase the ROA and keep the total leverage on and off balance sheet in a range where we can deliver at 16 to 18% of ROA. Our view is that investor fidelity. See, we are on related capital. I keep saying that. What does mean by related capital? We don't have a owner whose need we are servicing. We are servicing the management need of all of you, including our institutional investor, the private equity investor, instituting the public market shareholder. What people like, obviously, we are public market now, everything goes double, triple in 6 months. But eventually, in our industry, especially in the lending industry, we like consistency. A company which can grow at 25 to 30%, a company which can do a sustainable credit cost, a company which can deliver income to OPEX issue. So that's what we say. That our integration things, we raised a lot of private capital, we build capacity, we have built an operating infrastructure, and as we end 8-9 quarters, this company, for a very long period of time, will match this. We will grow at 30 to 35%. We are loading credit cost of 2% around, we will get to a 4% of our, which will start generating more balance sheet power, and get to an income and OPEX ratio of 45%. When you believe that, people would like that. And that is the early signs of building an institution. Building an institution is also important because the stability and sustainability of a lending institution is also a size and scale. And it can be a very high, look at the microfinance industry. So all of you are buyers of microfinance company in certain cycles and sellers still certain cycles. Because now the very established कि हर 3 साल में microfinance industry में बड़ा loss आएगा फिर वापस से revive हो जाएगा. That's the model of the business. But can you run that for a very large scale? Answer is no. NBFCs are going to size of 3 lakh crore, 2 lakh crore, 1 lakh crore. Can you build microfinance business of 3 lakh crore? Probably no. Can you build an MSME financing of 2 lakh crore? Answer is yes. So that's the aspiration in the state.
And so my last question was on ticket sales. So if we see annual report, for specifically for supply chain financing, the ticket size was fallen from 95 lakhs to only 13 lakhs. And overall also there's moderation in ticket size. So what is your philosophy going forward? Are you looking for, granular loans or?
So you're very right. Right now, I'm focused on the supply chain. We're focused on the tier 1 and the vendor side of the supply chain. Here we will still continue to be a last mile supply chain or retailer financing business, which means we fund the retailer to the distributor like, which means granularization, which means large number of retailers and therefore granularization of business. Focus issues on micro enterprises. The area today, which is at 12%, will go to 14%, which also means granularization of business. So there are two fundamentals to asset growth. One is granularization of business, and second is yield increase. And all these businesses I spoke about, whether it was the retailer finance, which runs at about 20% ROIs, the micro enterprise business, which runs at 20%, or any other business that we did, which is granular, runs at higher yields than the traditional supply chain businesses that we're focusing on. So granularization and increase in yield is doing the only two fundamentals to asset growth.
See, this granularization is a natural progression. See, Once I looking the growth of micro enterprises branches from 75 to 150 to 250 to 700. Right? And once the, from 125 crore of exit terminated in July, then they get to say incident maturity at 300 crore of one way. Those are happening at an average ticket size of 1 lakh rupees. Versus our prime secure business will remain static because we don't think so that there is any need to increase the volume of that. So our prime secure business, which is roughly around 100 crore or one, would remain 100 crore. Our business level, which is around 200 crore, would remain at 200 crore. Our prime secure business in average ticket size was 7 lakh. Business loan is at average ticket size of 19 lakh. And when we augment our retail financing business to some of the large partnership and embedded financing we are doing, once you start building thousands and thousands of customers into the system, it is the mix changing which will automatically change the ticket size. So that is just by distribution, growing in a certain direction, which will automatically build out the ticket size. However, we continue to be the same. To be a safer lender, you have to granularize your portfolio. You got too much low ticket size, you suffer from credit cost. If you go into sub 2 lakh, sub 3 lakh, maintaining credit costs in the range of 2% is very difficult. That's why you have to be in the pyramid of this 15 lakh to 15 crore customer bag and ticket size between the say 2 9 lakh rupees. And that's where we can lead.
So with that, sir, can we expect with granularization of that supply chain financing, the NPs in that category will fall from 7.5. What do you like say?
So that NP number is looking artificially high because we have been running down that portfolio and we are transitioning. So some of them are historical cases which in we are in courts board will get resolved. And after, because the portfolio will become granular, then when real LP gets built up, will get changed and will be in the range of 2% on a steady state basis.
And the chamber of that is very small.
Yeah, that's it from us. Thank you.
Yeah, so one thing that you've been saying is that there are people who are quite strong in business lending in the south. Then there are people who are quite strong in Rajasthan. Whereas our USP is that we have, spread all across the country, our branches of government. But surely, this kind of knowledge is built over a wide period of time and also built by retaining the talent that you have. So how, as a young organization, can we claim to be having a similar understanding which other entities have taken their own time to sort of establish?
Yeah, very good question. So first, it's a function of capital. Okay? If you start with a large capital, so it is, but it was with this organization got evolved in India. Right? One by experience, something what we call the desktop research. We are a desktop research company. So if I give you, so if you look at all of our language institutions in the South, they are technically some three large institutions. Chula, Sundarbans, right? So people who are right from those institutions for a very long period of time, actually people who are spin as somewhere within their geography because their geography, people, they clear the institution. But that also became a bottleneck because their ability to decisionally look at the whole landscape and on-way talent have been a challenge. One of the reasons why one is small finance bank, one is small finance is because of this reason. Because there is a sense of understanding, I rely on mindset of people and they rely on the geography. When we looked at it, we looked at the market opportunity. Because we lacked our initial capital on our historical track record, not on the basis of any company performance. Now that capital, there was the capacity, and when we looked at all of our peers said in what is happening and how we can do that, we struggled, honestly speaking. So that will give you a very unique case. So we realized this very early on कि दिल्ली बॉम्बे का कोई आदमी साउथ का बिजनेस नहीं रन कर सकता. So micro enterprises should be divided between south and north. So for a south business, we need both credit plus sales to come from south, and we should not have any one for north business. Both credit plus sales for north should be not in the micro enterprise business. We said when that south sales head should manage 3 states, Telangana, Tamil Nadu and Karnataka. And we started looking for people. And we struggled for 1 year. because we knew the person who knows 3 languages. Tamil, Kannada. We cannot find a person who sells fraternity, industry, boats and activity who knows all the 3 languages. If you don't know all the 3 languages, you cannot manage the Karnataka and Telangana geography. So that is a lens through the understanding which we will learn. That's the way we design now where these are different pockets of business. They have to put it in autonomous institution and we run it through a governance framework. And the fortunately, in our industry, the talent pool has been growing. And people like to work for a professionally owned company wherein they have opportunity to grow and they can do that. People definitely like to get there. So if I ask you this question in Rajasthan, how many NBFC will be above 5 billion crores a year? And we publish about 15 crores. There are 140 NBFC in Rajasthan, which are above 5 billion crores a year. Now, think of that. Can they become 5,000 crore income? The answer is no, because they are all run by professional, private entrepreneurs who all see the view and become things, and even we can become a you. But only 3 of them actually have now grown. But there is so much of talent there, which is willing to come to an institution which is between size. Size attract talent, and then obviously there is a lot of so mention होता है कि हमारा ये टाई सूट का जो कल्चर है ना इस विदार्थ के we have to get to the ground and we have to learn people and then understand word more economic pursuit than anything else. People like success, and once you create success for them, then you stay for that. I don't see any challenge on that, but it's a tough job. Second, I think the most important thing is in the any institution as for that matter, only financial services business, is to retain top 50. Any company which believes that they can retain a really hierarchy, then it is not possible. We know ridiculous language. People are literally aspirational. People forget about jobs. People now are doing their husband and wives on some low line and reason note. So people at the bottom of the planet would definitely change with opportunity of any high. But we have been able to retain our top 50 on the aspect of believing this philosophy that those 50 believe that this is their company. They don't address the need of love, and they are economically incentivized, lacking compensation. That's why I talked about that, 5.5% between over a period of time in real ownership as a company, which has potential, if you look at today, at the end of 2026, our net worth will be 3,300 crore. Our market cap is 2,500 crore today. So our people know that what economic value this 5% can deliver to top 50 people. And they would like growth. They would like to be recognized to create an institution and simultaneously benefit from that in terms of their economic ownership. And that's why top talent is retained in this company over the last 2-4 years.
Thanks so much.
You need a question from me? You look really good.
No, so I always said with players of I think so. As I say, that on the ISL, this is a company which had been some of you was a trackers and thanks of people who tracks us, but given that we never had an opportunity to bring this company from private to independent and create an IPO, hype around us, the prices. That's why a lot of public market participants don't know us. We had been poor on actually reaching out and exploring our business model. We were put in this conscious crack. Given that now we have landed our capital for the next 2 years of work, we also have the luxury of time of building our business, but simultaneously telling about what we are trying to do. This is a very highly aspirational team which want to deliver a large institution to India. And that's our commitment. We have 24/7, and also we work our existing investor or prospective investor would benefit from that. It is just matter of cycle and execution, and with that you will continue tracking us for many quarters and years to come. Thank you for attending this.